Ladies and gentlemen, I take the pleasure of inviting up on stage Shri Pramod, the Executive Director of Securities and Exchange Board of India, for his introductory remarks. To commence with this panel, I request you all to kindly welcome Shri Pramod up on stage with a big round of applause. Thank you so very much, sir. Ladies and gentlemen, may I also request all those of you present here to kindly take your seats as we're already started off with this panel discussion. Mr. Pramod is up on stage for his introductory remarks. Thank you, sir.
So good morning to all of you. Thanks to, of course, GFF for hosting several of now the securities market intermediaries and what we have accomplished in the last few decades to be showcased here at GFF. What I'm going to be talking about and what the panel is really going to be dealing with is a key policy objective for SEBI, namely democratizing access to the bond markets. So let me begin with a few important statistics in this behalf. We have over the last financial year seen equity issuances aggregating at least $25 billion. In the same period, debt issuances have exceeded $100 billion USD. The aggregate corporate bond outstanding is in excess of maybe $560 billion. If I combine the entire fixed income segment, and by that I mean the G-Secs, the SELs, and so on, we are closer to maybe 2.3 trillion, 2.5 trillion USD. This to me is a huge market, and I think that's the first acknowledgement that we need to give to the bond markets. A whole host of market infrastructure and technologies and platforms supports this level of issuances with the scope of much more being supported. So some key items I will touch upon. For instance, we have the electronic book building platform for the private placements. With QIBs, which is the institutional investors and so on onboarded, this platform is actually unique in around the world. There is no other market which has a private placement of debt securities being supported through exchange-operated platforms. And while it began at issuances above 500 crores being supported, today it supports issuances of 50 crores and more. To me, what we are looking for, and indeed what I think a forum like this offers, is for fintechs to tell us what else should we add to the OBP platform. What else are the features we are looking for? What else will allow us to sort of amplify its reach? Just as EBP supports the primary issuance, we have a request for both platform, that's the RFQ platform which supports the secondary market. This is in addition to the debt segment of the stock exchanges. And what this RFQ platform has done is, again, brought what was otherwise a telephone market, one-to-one dealing on the bonds being actually migrated to a platform. And again, what we are looking for is intermediaries who will keep on getting added to it. We have certain limits that we require transactions being put through to the RFQ. We are looking to how to enhance those as well. Again, to me, the vision is to say that RFQ can become as deep a market as equity markets in terms of liquidity and demand that can be serviced. There are several other measures for the secondary market, and key amongst them which we've been trying to figure out, and where I welcome inputs, is introducing market making. For some reason or the other, we've not been able to sort of get to that. Yet, it's not for the want of ideas and thoughts. One of the consultation papers we recently issued actually deals with introducing liquidity windows offered by the issuer themselves, utilizing put option structures and so on to make sure that investor indeed has access to liquidity when they require. The online bond platforms, and you're going to hear from several of them today, should be at the forefront to popularize this and make it even more available to the investors and issuers who may want to resell such bonds. We continue to look at other means to support secondary market liquidity. Just as the governor has urged banks to be innovative about mobilizing bank deposits, I urge the issuers of bonds and supported by the market infrastructure to actually do so for bonds as well. Another instrument which has gained quite a lot of traction and which is becoming popular is securitized debt instruments. Usually banks, NBFCs, enterprises with receivables can actually harness this particular instrument as well. In the market parlance, they are sometimes called PTCs. To me, each of these instruments, whether corporate bonds, STIs, what we permit in terms of listed securities from the government and so on, I think all of them become what indeed OBPs can host and make available to the investors. Beyond this, we are equally looking at how to expand what I would call sustainable finance frameworks to investors who have interest in sustainability being supported. Those bonds will also hopefully start becoming available. I have talked at the previous forum about how I believe urban infrastructure can be supported by municipalities which can issue municipal bonds. We have a very nascent market, maybe about 10 or 15 issuances that have occurred. The size is nothing to go home, but if I have to look at the US market, the outstanding there is almost equal to our economy, $4 trillion. And when I think about that and I think about annual issuances being in the range of $300 billion plus, the potential in India and the need that we have for urban infrastructure can probably come from municipal bonds. When I mentioned it at the previous forum, people reached out to me later saying, is this too risky? Isn't it too difficult for investors to digest? And the point I make to them is that SEBI regulations have actually ensured that they have to create a debt service reserve account, they have to have cash flow trapping, there are rating requirements which are imposed on municipal issuers. So all of these should lend credence. Moving back to the corporate bond markets itself, we have, with the ease of doing business, enabled issuance of GATE, which are simpler offer document formats. Again, for us, the reduction of the size of these documents has also meant that we have harnessed QR code to sort of give access to the information rather than make the offer document bulky. Amongst other market infrastructure which I especially call out is really the depositories. Apart from whatever else that they have done for the equity market, all of the corporate bonds also are held in demat form with the depositories. The other thing interestingly depositories operate is the corporate bond database. The further item which they are linked to the bond markets is operating something called security and covenant monitoring. This is made available to debenture trustees and to issuers to sort of monitor the compliances. Again, I would urge the Fintech to sort of look at the information that we house in these databases, in these systems. Can we bridge information asymmetry with some of the APIs being linked to these systems and databases? We equally are very proud that last year, June, at the hands of FM, there was a corporate bond repo market which was launched. And I'm happy to report that in a year's time, the volume in the repo market, corporate bond repo market, exceeds 1 lakh crores. On average, every month, we are seeing transactions greater than 10,000, 15,000 crores take place. For those new to this, what it allows really the repo market is that you can borrow against the bonds you own for a temporary liquidity that is provided by this corporate bond repo. This ability didn't exist until a few years ago, or rather until this came into being. Again, we are in dialogue with RBI to allow primary dealers and banks to participate in this as well, and to me that will only deepen the market. And yet, and that's the point I call out, that 1 lakh crores has been reached without bank or PD participation. Should only tell you that there is depth even without them. Similarly, the debt market, the debt mutual fund schemes and so on have also been bolstered by a facility launched last year called the Corporate Bond Development Fund. It's actually a backstop facility which backstops the entire debt mutual fund investments and is guaranteed by the Government of India, along with the contributions that these debt mutual fund schemes make. The limited point I make is that SEBI is committed to continue developing the debt markets and making sure that there are market infrastructure institutions which support the superstructure of issuers, intermediaries, investors with the goal of Viksit Bharat. I'll switch gears to a few critical infrastructure which I believe underpin our markets. The credit rating agencies are a critical component. We keep on telling them that they have to be what is the army slogan as well, please shockers. Constant vigilance on the issuers that they monitor. The debenture trustees are again an integral component of the bond markets, and while in the normal course they are not necessarily in the forefront, in case of defaults or delay, they take the forefront on behalf of the investors. And which again, we urge them to be professional and be able to harness all of the measures. To me, the one other fixed income segment which has emerged and yet has a huge potential to grow has been the recent Indices market, and we have introduced a new asset class called SMEs, which brings into the SEBI fold what was earlier operating as fractional ownership platforms. The scale and size is something really to register. With just 30 entities, the size of this assets under management is today about $76 billion. Right? And to me, ex-Japan, this is the largest REIT InvIT market in Asia. With SMEs, my belief is again, this is set to grow. Being in GFF, I guess the focus is clearly Fintech. Apart from everything else that the securities market does, which is right on technology, seen and unseen, what we have been obviously doing is be observing these developments, and amongst them has been the emergence really of the OBPs. To me, it caught the imagination of investors and it caught our attention as well, which led us at some level to bring them within the regulatory purview. And I'm happy to say we have 20 which are linked to BSE and about 17 to NSE. And again, we urge them to organize themselves into an association which allows us to have a collaborative approach towards developing their role as well. Within all of the slogans which we have, various associations take, the one which strikes the most for retail as a chord is AMFI's mutual funds regular. So the one which I tell OBPs and their association is, what you really have to drive towards is bonds for Bharat. With that, let me hand over to the panel. Thank you so much.
Thank you so very much, sir, for that introductory speech and remark. And now, please join me in welcoming our esteemed panel up on stage. We have a moderator amongst us, Mr. Vishal Goenka, the co-founder of IndiaBonds. Let's have a round of applause. And I'd like to welcome our esteemed panelists, Mr. Ajinkya, Kulkarni, co-founder at Wint, Mr. Suresh, Darak, founder at Bondbazaar, Mr. Mukesh, Agarwal, Managing Director, NSE Indices Limited, and Mr. Vijay, Krishnamurthy, Interin CEO, India, INX. Let's give them a big round of applause and welcome them out on stage.
Okay, good afternoon everyone. My name is Vishal Goenka. I'm co-founder of IndiaBonds. I'm going to try and cover 3 to 4 years of development in 30 minutes. OBPs, online bond platforms, I think have awakened a sleeping giant called the bond market. The size of the bond market in India is $2.6 trillion already. But if you compare it to the Western markets, bond markets are 2x of GDP, whether it's the US, EU or Japan. In India, we are at barely 65%. At this rate, we feel we'll add $1 trillion to the bond market in the next 3 years. As JP Morgan index inclusion have brought international investors, OBPs have taken this asset class to the masses. Thanks to technology, issuance of bonds, covenant monitoring, payments, and information dissemination has been accelerated with the use of technology. I think India bond markets are far ahead and developed than our EM peers and also developed markets in the West. Simply, a bond in the US, minimum investment is $200,000 or 1.65 crores. In India, you can buy a bond for $100 or 1,000 rupees. So far, the bond market has been captured by large institutional investors, but not anymore. I think democratization and digitization is going to move what we call inefficient capital to fund companies and governments for the growth of the country. Let me move on to the panel who are practitioners of online bond platforms. My first question to you, Ajinkya. What does democratization actually mean? And what have you achieved in the last 3 years?
Democratization simply for bunch of reasons, these bonds were available to HNI, under-HNIs or institutional investors. How do you make it available to retail investors? So first is availability, then second is how do you educate them, right? Whether this is the right thing or whether they should invest or not, right? And third, then the next step is how do you acquire them, as a platform, how do you acquire them, and fourth is how do you service them. Obviously, like what happened in equities, technology is a very strong factor here also, right? Earlier, when we started Wint, we used to see like how these bonds are sold. They were sold by RM who would go pitch into some HNI, and that RM should understand basics of the bond, etc. And therefore, when you need a fairly educated RM so that HNIs can trust him. So the cost of acquisition is basically that RM going and pitching that product, which itself is high. Then servicing that RM taking that relationship, so RM can only maintain certain relationships, right? So cost of acquisition was high, cost of servicing was high. With technology, I mean, these things have changed now. We are able to, most of our customers come through, a technology platform of ours, where we don't have any RM dedicated. We get educated through the content, video content especially. Right? And then we service them using dashboards, etc. Right? And regulation, so technology is one factor and regulator is another factor which has played a great role. When we started listed bonds was 10 lakh ticket size, majority of them which are privately listed, right? About 98% was them, the minimum investment was 10 lakh. And then 2 years back it came down to 1 lakh and now it is coming down to 10,000, right? So that is another factor in democratizing the market is regulation. And unfortunately, the regulators have taken a keen interest and have been very supportive. So that's the two factors are contributing. One is technology and second is regulation.
So thank you. I think you can actually buy a bond in less than 5 minutes online in India. And believe me, nowhere else in the world retail has that access. So you spoke about regulation and maybe brings me to my next point. To Vijay, why now? What has the regulatory, what have the regulatory changes happened in the last year and a half? And if you walk us through that, that would be great.
Absolutely. Good morning and good day to the entire audience. So if you look back at the Indian bond markets, so I would say 2 decades back, completely opaque, hardly any liquidity, very few market participants in terms of institutional players. And slowly we had a lot of regulations coming in place where it said that any corporate bond transaction happening needs to get reported. And so there was a little bit of transparency that got built in somewhere in the early 2000s. And come 2009-10, it also started saying that we need to settle these transactions to the clearing corporations of exchange. Now what this really did is give a lot of confidence to the investors themselves, because although it is not a settlement guarantee thing, but through the CC, at least the counterparties are assured of their funds and the securities that it wouldn't really go into the wrong hands. So that was a very big step. And what all of these really did was it started providing data to the market. What are the transactions which is happening? What is the level at which these transactions are happening? So it slowly started increasing the liquidity and the information about the price, who's trading, what are the kind of bonds which are trading. So that was a very, starting point where exchanges and the clearing corporations were really involved. Now, given the dream of this government where we need to move to a 5 trillion economy, we can't only depend on institutions or bank lending to really do that. What do we need? We need retail investors to really come in a big way and invest. So definitely, there has been a lot of discussions, and regulators have also been very supportive in ensuring that this path is really very clearly driven. And come into the picture the OBPs, online bond platform providers. So somewhere in the period of October 2022, precisely October 19, 2022, there was a government gazette which said that all the OBPs need to get registered, become the registered members of the exchanges. What does this mean? There is a seriousness. All these OBPs who are outside the ambit of regulations have been started to get regulated because they are going to get retail into the picture, and so the protection of investors has been the primemost importance of a regulator, and rightly so. Then there were, in November 14 of the same year, we had a little bit more guidelines and detail with which the OBPs really need to operate. What are those various operation guidelines that needed to be come into the picture. And then again, several codes on advertising and how we really manage risk, and all of these things happened, and there were multiple meetings and multiple working groups that were formed under the guidance of the regulator. And what I can say is, after all these things, and the best part is, they are all seamlessly connected to the exchange. Right from the transaction for a retail, as Vishal really mentioned today, you can buy a bond. I would say is been a little conservative to say that we can buy in 5 minutes, but to me, you can definitely buy a bond and put it for settlement in less than 2 minutes, because that's how seamless it's really become for the Indian bond market. So in the OBP, there's a list of securities that are allowed, and SEBI has been really monitoring that, and they have kept on increasing the list of securities that could be really bought. So not only the corporate bonds or the munis or the so now you also have the sovereigns that are available for somebody to really participate there, and sovereigns can be bought as less as ₹100 on that platform. So from the time you invest through the online bond platform, through the APIs that is connected to the exchanges, once the transaction takes place, it automatically moves into the clearing corporation for the settlement. And even for the payment process, it's very seamless. All these platforms are connected with the payment gateways. So as soon as you place your order and your order is confirmed, the total of the consideration that really needs to be paid is popped up. From the online platform link itself, the payment can be very seamlessly made and transferred. So it's extremely seamless, and technology, since we are a Fintech platform. So this is a very great example of how technology has leveraged and how bond markets have really leveraged on the technology capabilities that India has come. I think so it is unique to India. I don't think so anywhere in the world bond markets have really moved this far. And by doing all these things, what we have also done is created a lot of transparency, number one, got in a lot of retail investors, as Pramod sir just mentioned. We have a good number of 25 odd OBPs who are already there and operating. Through them, at least on BSE as an exchange, we have about more than 178,000 investors who are already participating, and these are retail guys who are really participating. So this, the entire thing with the help of the regulator by putting appropriate checks and balances, at the same time giving them the necessary leeway to ensure that they are able to garner the retail crowd, to pull in the retail, and with appropriate checks and balances for the protection of retail investors. I think so we have done pretty well, and it's only a first step, I believe, and we are working very closely with all of these, the market participants, the regulator and the other MIs, exchanges are working very closely with each other through the association and with the regulators to ensure that how we can really grow the leaps and bounds. So that's what is the current situation, Vishal.
Well, thank you, Vijay. So what I pick up that the regulation is being very proactive to protect and enable trust for investors. And one interesting fact that actually investing in bond is safer than investing in equity. And you will ask me why? Because your money goes to the clearing exchange directly, not to your broker. So thanks to people on the stage, we've kind of reached that. Which brings me to Mukesh. Mukesh,
what is the role of the exchanges in this? RFQ direct platforms, and the entire ecosystem has also been enabled by exchanges. How do you see this pan out?
I think exchanges play a very important role in this OBP, because if you look at any order, all the OBPs are connected to RFQ, which is a request for quote platform offered by the exchanges for trading of debt. So basically all the OBPs are connected to the exchanges RFQ through an API, and all the orders which are placed, they get executed on the RFQ platform of the exchanges, and the settlement and clearing happens with the clearing corporations of the exchanges. That is one. Second thing is there is a regulatory oversight on these OBPs, because all these OBPs, they are stock brokers and they are members of the stock exchanges. Third is, as I earlier also mentioned, the money can be paid through various payment modes like UPIs, NEFT, RTGs, and through the payment aggregators. Good thing is, there is no pooling of money by the OBPs. The money from the investors directly goes to the clearing corporation of the exchanges. So that too, your money is similarly, the security will also directly move from the exchanges clearing corporation to the investors. So that is there. Now, other thing is, only listed bonds are allowed to be traded on OBPs. That is again provides some comfort. Last, I would say that is, since they are regulated or overseen by the exchanges, as an investor, the KYC process is very easy and KYC is done for all the investors. Second is, there is an arbitration mechanism which is available. Third is, there is a investor grievance mechanism, because exchanges have an investor grievance mechanism. So I think given all these things, RFQ exchanges play a very important role, because as I said, trading and settlement happens with the exchanges.
Thank you, Mukesh. I think, Suresh, you've been part of the market for a couple of decades. How have you made it more transparent and better for investors? And maybe touch upon how is the offline process for decades in the country?
I think bond market is one of the most transparent market as compared to any other sector, I believe so. Most regulated market. From the issuance, everything has to be done by a SEBI appointed agency. When it comes to information memorandum, it is by a merchant banker who vouch whether the information is published as per the SEBI guidelines. It is a credit rating agency which is regulated by SEBI who rate the issuance and capture the essence of the issuer. When it comes to primary issuance, as Pradeep sir has just said, electronic bidding platform, best price discovery mechanism in the primary market itself. First is the primary market. Price discovery happens there. Then it comes to the secondary market. Two critical aspects. One is, you publish the price, reporting and settlement is automated. But the biggest part of this thing, in bond market, when it comes to price, you are not talking about like 15% return you can get or 20% return you can get. You talk about in paisa. If it is 12.01%, it is 12.01%. The calculations are verified before reporting by the exchange mechanism. So everything is transparent. So transparency in the primary and secondary market is the highest in bond market, I guess, which is unparalleled and seriously great. Now, price discovery, with technology, all prices are published. So it is very easy for any investor to cross-check the price. Not only on the exchange mechanism, there are two mechanisms as Pradeep sir also said, debt market of exchange and the RFQ mechanism. Debt market is an anonymous trade. Anybody can buy and sell any bond just like equities. So it is anonymous. Best price discovery mechanism. When it comes to RFQ, all the prices in the primary market are also listed. So discovery of price is also one of the best and the transparent. So that is the fact. I guess from here onwards, because the understanding of bond market is slightly less. So sometimes when the understanding less, we can't appreciate the transparency also. I believe as the understanding of bond market grow, people will start appreciating probably one of the best transparent market.
Thanks, Suresh. But traditionally, buying a bond takes about 2 hours.
for an nation, getting a code and getting payments, and this is not done in 2 minutes. So really a big giant leap. You touched on education and awareness, and Vijay, back to you. There are 162 million demat accounts and roughly 2% only that are fixed income. What, as an industry, are we doing for education awareness, and how can we improve that?
So definitely, I think so there's a lot of role for each one of us as an MII, as a market participant, and for the entire ecosystem to really do that. And I think so we have begun well. Right, I really mentioned like at least from one of the exchange perspective or ESG perspective, we have seen that certain numbers of more than 178,000 investors who are really participating through the OBPs, and I would like to also say that since Mukesh really mentioned that OBPs flows into the RFQ, which is part of the exchange, and then it really moves into the clearing corporation houses of the exchanges. So very surprising, for the last 1.5 years on an average, I would say 25% of the overall market trades are through RFQ, and out of the RFQ itself, where OBP is really need to push it to the RFQ, 25% of those transactions which happen on basis of market value are done by the OBPs. And because they are small ticket and retail kind of investors, a very interesting number to really note is 74% of the number of trades. 74% of the number of trades which flow into the RFQ is thanks to the OBPs. Right, because they are able to garner the kind of retail investors with small ticket sizes to come in. So that's a significant number, right? So, when we say 25% of the overall market is RFQ, within that 25% is the OBPs, and the number of transactions through the OBPs is almost 3/4 of the transactions on the RFQ. So this is just a beginning, well beginning is half done, that's what I believe, but that's a long way to go. Because as there are other instruments which are getting popularized, sectorized debt and so on and so forth. The very important part is to educate people very clearly, and it's very important that also we need to avoid some kind of I wouldn't say mis-selling, but somewhere where we need to really make it very clear to the retail that debt is not risk-free. Because it is very important for normal retail investors, debt is akin to a bank deposit. But I would also like to say that banks have failed and deposits have not been got back, only to the extent of what was the insurance you got it back. Right? So even there's a risk there. So very clearly, it is the responsibility of each one of us sitting here in this thing, or anybody associated with the debt market, to very clearly make it in very simple terms, to put it out to the market that debt is not risk-free. There is a risk involved in that. You may not get your capital fully back, or you may get in capital appreciation, you may get a little less than your capital, or you may use your entire capital. So this is something which is very important that we should really put it out.
No, absolutely. The global debt market is $133 trillion. Obviously, it cannot be risk-free. I can see the clock ticking at me. Two more things. What are the challenges and opportunities you think going forward? Maybe Mukesh, you can start with this answer, and Ajinkya, please join.
Other than challenges, I will start with opportunity. I think that's a very important thing. So if you look at LSE, today we have 10 crore unique equity investors registered. I assume all of them would be trading in the equity markets. So first 1 crore investors, it took 25 years to get us to the number of 1 crore. And you will be surprised to know that the last 10 crore, from 9 to 10 crores, happened just in 5 months. So that is the kind of interest and growth we are seeing in the investor-based registration, and that is for equity. So I think over a period of time, it will happen for the debt market also. I think investor awareness is very, very important. So once we focus on investor awareness and investors get to know that other than bank deposits for the fixed income side, there is a bond also an option as a tool available, which is available for investment. I think that is important. Second thing, another thing, if you look at retail investors account for almost 38 to 39% of equity trading volumes in LSE. So that is the kind of numbers we need to focus, and that is the kind of opportunity we have. Other number I will share is if you look at equity markets in financial year 24, retail investors invested net investments of 47,000 crores. And you would be surprised to know that in the first 4 months of the current financial year, retail investors have already invested 47,000 crores in the equity market. I think those are the numbers which we are talking about. That is the kind of potential we have. If we have those kind of number of investors investing in equity markets, that is the money which is coming into the equity market, 47,000 crores in 4 months. Why not in debt market? Even if we get 20-25% of that, there's a huge potential. There's a huge opportunity. I think we have just made the right start by having this OBPs. If we get our investor awareness right, I'm sure this will go a long way.
Thank you. Ajinkya, you want to add something to that?
Yeah, opportunity is huge, obviously, and we look at it saying, like, if somebody is in equity market for 2-3 years, that's where we see a sweet spot where people want to diversify beyond equities, and that's where they're looking for debt options and that. So that base itself, which is online, educated, is still 10 crores, so it's a big base, right? None of the OBPs are big compared to that scale, right? So there is a big opportunity. On the challenge side, I think there could have been a challenge which is already mitigated in some senses. Like we saw what happened in P2P industry where kind of the players were not acting in spirit of the law and then regulated to the heavy action. I think we already have a OBP association in place which kind of is propagating good actors, making sure if anybody is doing any bad thing, it is arrested right there. Right. So that's a good thing, and that's a good thing needed for ecosystem and investors.
Absolutely, going in the right regulated environment is where, fintechs like us can innovate. The clock is turning at me. One last key message for the audience for the bond market in OBP. Suresh, let me start with you.
Sir just said bonds for Bharat. It has much deeper meaning. Actually, bonds is good for the prosperity of retail investors, and it is essential for the prosperity of the nation. It is critical component to reach our target $1 trillion economies. It can be 5 trillion trade a year. So bond for Bharat is for everybody.
Ajinkya.
I think all of here are fintech practitioners. This is one space where we are seeing strong regulatory tailwinds. In many other spaces, we are seeing strong regulatory headwinds. So if you are a fintech practitioner, do check out our platforms and do be able to go and you will see a lot of positive action in the next 5 years.
Vijay.
Bond investing in India is relatively safer and it gives you a good opportunity to diversify your risk. It is highly technology oriented, end-to-end connected, automated. So if you want to buy a bond, earlier it was a challenge, but right now you can buy bonds as low as 1,000 rupees, 10,000 rupees, 1 lakh, and if you're investing in government bonds, it is as low as 100 rupees. So it's a big opportunity for everybody, other than the institutions. Retail guys have an opportunity now, so definitely, I would suggest that that's a very good avenue for your asset allocation.
I would say that OBPs are kind of Amazons and Flipkart for the bond market. So, and for if India has to reach $10 trillion GDP by 2033 and $30 trillion by 2047, bond will play a very important role. And for bond markets to grow, retail investors have to play a very important role. Because today, if you look at it in the bond markets, we have a limited number of investors, very limited number of investors, and most of them are holding to maturity. For bond market to become vibrant, retail investors have to come in, and that is, they will play a very important role, and I think OBP will play a very important role in driving that forward.
Absolutely, I think the key message is that OBPs have been energized by regulation to accelerate retail investment in bond market, and simply bond in every hand is what we look forward to. Do we have time for any audience Q&A? Sure.
So, ladies and gentlemen, we have time for just one question on this forum. If any of you do have a question, please raise your hand. We will have a mic sent over. Yes, can we have the microphone to the gentleman up in front? Okay, so please go ahead. Yeah. Hi, thank you so much for this session. I just have one quick question. So most of the OBPs at this point of time
are auction houses, right, where they probably tie up with an NBFC or they run their own books and they downsell the bonds. As the market is growing, and as you're all mentioning that it's going to become a marketplace, how do you see that transition happening where there is enough liquidity, like the equity market, where the buyer and seller are able to meet by themselves? And the auction house requirement is not there because I feel that limits the transparency in the bond market in its very nature, which the equity market doesn't have. So that's my question. Thank you.
Vijay, you want to take it? Sir, absolutely. I think so just, quickly, 2013, exchanges had provided a platform wherein people could come and do an order matching as similar to equity, right? Just to give you, a flavor of the debt market, equity, if I say Reliance, right, it's only one Reliance which is there. In debt market, when I say it's a PFC bond, so there are hundreds of PFC bonds which are available, of which 50 are of the same year maturity, of which at least 10 will be of the same month maturity. Right? So it's a complicated market. It is not a very simple market where I will put a price and a yield and an order can match and can go through. Right? So for this, the ecosystem has to develop. So there has to be a negotiation. People on both these sides need to understand what are the terms and conditions of the bonds. Each bond has a different terms and conditions. That's why they have a different ISIN. Right? So it's a little complicated market. What I would like to just say that is through the RFQ, through the OBPs, we have made a beginning. Right? We have taken the first step. Now also with the restrictions on the number of ISINs that you can only issue about a max of 9 ISINs and then it has to be issuance. So what is going to happen is from the outstanding about 13,000 bonds which is there in the Indian corporate bond market, over a period of time, it is going to come down to a reasonable number. So which means what? There are limited number of bonds by an issuer, more chances of higher liquidity in those bonds, concentrated liquidity in those bonds will happen. And the best part is because 95-96% of the bonds are a private placement market, so held with a very handful of people. Public issuance market is going to open up. We are going to have bonds as less available as with the face value of 10,000. More of retail participation. So that is only going to be the way forward. So we have taken the right steps. We are doing it slowly to the RFQ, to the OBP side. So we will reach there. But expecting too much too early is, maybe really not there.
Just to add on to that, I think once you have sufficient number of investors, a market risk will be liquid by itself. On Vint itself and a bunch of other platforms will also launch liquidity soon. So we will enable our whoever has bonds with Vint, they can come and sell on the platform anytime, and there will be buyer-seller mechanism. So eventually, yes, it will go there, but auctioning is also kind of market making, mini market making today, right? And it will go to a mature state once we cross a certain threshold number of investors.
Thank you. We have time for just one more brief question, sir, if you can.
Could you share some insights on what sort of content and research ecosystem you see around this? So when we're talking about ecosystem, what more content can be developed or as a research analyst? What more could be done?
Maybe I'll start with that. I think a lot of the platforms have a lot of, like on our platform, we have original content, blogs, videos, credit notes. In terms of research, I think that's a separate advisory, and some of the platforms are doing advisory. 3 years ago, you couldn't even find a detail of a bond in India, right? And now, mandatorily, you can find information memorandums, details of every bond that you want. There are comments about macro movements and different credit stories. Anyone wants to add? What information?
Okay. Research. Actually, bond is a very simple business. Just an interest. You are getting interest on your investment. Rating agency every year for each and every company publish the rating rationale. If you can consider it as a research, unbiased research, facts about the company, and give me a rating based on the risk parameters. So first thing is, it is very transparently covered through the SEBI mechanism, right? I think when we are talking about research, it is about probably overall bond market and all other things. Probably a lot of data is available. We may be just a facilitator of providing that data. Unlike equity market, where you require research that whether the stock will go from 100 rupees to 500 rupees, probably those type of things are not required in bond market. It's company specific, company is creditworthy or not. It is transparently published by a rating agency every year about each and every company.
Thank you. I've been told we will have to conclude this session. Thank you, Shri Pramod for the opening remarks and my panelists for the time there. Thank you for being a great audience. We are here to chat after this panel if you require. Thanks a lot.